Everybody. My name is Yusra, and I'm so thankful for your attendance. I am, hold on. I am most recent member of a broad consult. I'm also a master's graduate in Islamic Finance, and I'm passionate about Islamic finance. I'm so thankful for Abrar for giving me this opportunity to be a part of the team and to revive my passion for Islamic finance. And this is the perfect way to start by doing a book review of this capacity, which is a very beginner-friendly book. Broad Consults is an Islamic finance business and advisory company, and they deal in training, focusing on Islamic finance and financial and business education, financial planning, product development, Sharia review, halal tourism, and others. Our agenda for this book review contains these segments, and inshallah we can be able to complete, but in the interest of time, I'll be focusing on some of the main Islamic finance products that most of you express in the registration form that you'd like to know about. So what is this book about? There are very few books that explain the features of Islamic finance to actual consumers, Muslims as well as non-Muslims. And this is one of them. So this book demystifies Islamic finance, and its emphasis is on oversimplifying the subject and making it highly readable for those seeking to have knowledge on Islamic finance, especially an introductory knowledge. And the authors are Daud and Kyonchi, who are both reverts. They found Islamic finance quite challenging at the beginning, so therefore they set to demystify it. Daud is a leading figure in Islamic finance and the former CEO of InSafe. Kyonchi is a financial writer with deep knowledge of wealth management. He also co-authored Make Your Money Work For You. One of the reviews on this book is that it's a must-read introduction to Islamic finance. And inshallah, at the end of this review, you will be inspired to read it. This book themes and summary are mostly centered around these areas. This doesn't necessarily mean that the timeline is based on these areas, like it starts with this, what Islamic finance is, and with future of Islamic finance, and in between, but more like each chapter is based around addressing misconceptions and practical examples. So what is Islamic finance? These are the core concepts of Islamic finance. These are the belief in divine guidance and no interest portion, no haram investment. Risk sharing is also encouraged, and financing is based on real assets. So Muslims believe that Allah's commands cover every aspect of life. So as opposed to in the conventional financial system, where religion and government are kept separate, uphold religious freedom. In Islam, Islam guides every aspect of our lives. No interest. As some of you may wonder, so then how do Islamic banks make profit? If they don't charge interest, then you would be interested to know that actually interest was not only banned in Islam, but even pre-Islam by major religions such as Christianity and Judaism. The author goes on to explain further about that in a book. So I'll not go into it in the interest of time. Otherwise, what this means is you cannot earn interest on a loan or pay interest rather. This is like similar to the concept of socially responsible investments, where the corporates who favor such investments, they just favor practices that promote human rights and consumer protection. This is also based on the no haram investments point, where money is to be invested in worthy causes. Companies that manufacture haram products like alcohol, tobacco, arms, and pornography are avoided. In Islamic finance, risk sharing is encouraged in business dealing with customers. This is for the purpose of equitable distribution of risk, profit, and losses, which is in contrast with conventional finance and is based on the promise to pay, where real assets are not tied to transactions. We'll see more about this later. Further, Islamic finance is based on real assets. Financing can only expand in step with the rise of the real economy. Fundamental prohibitions of Islamic finance. Riba is highly discouraged in Islamic finance because Islam views money as a measuring tool for value and not an asset in itself. Some degree of gharar is acceptable. This is unlike in riba, where explicit is forbidden explicitly. In gharar, some degree of it is acceptable. And this can be found in two conventional finance areas where gharar occurs and which are prohibited, such as insurance and financial derivatives. Another major prohibition is gambling, which represents an unproductive exchange of property. Because of its volatile and highly uncertain outcomes, gambling often leads to arguments, violence, and other crises. That's why Islamic finance highly discourages it. What are the common products in Islamic finance? We're already familiar with some of the conventional deposit accounts that normal banks offer, the conventional banks. So this Islamic version of them comes in the form of wadia deposits, which do not promise any return, although the bank has a discretion to provide you with a hiba gift. So this means that this wadia deposit account is only a safekeeping deposit account, but the bank from time to time can provide you with a return, but they cannot explicitly mention the regularity or when you can receive this hiba, the return, because that would amount to riba, interest. So if there's extra, the bank made a return with your money, then you will get the return. A mudaraba deposit account is where customers make the deposit and the banks use it as funds to make investments. So this is most commonly referred to as a savings account in terms of Islam. A card Hassan is another one that absolutely offers no returns at all. And the bank can use the money as it wishes. So it's basically what would be called an interest-free loan in a conventional bank. So you give money, for example, I lend you money and you return to me the same amount, no return. So I have put on here an example of one of the accounts, a Mudar deposit account, where you as a customer would deposit like 10,000 in the bank. So the bank puts it towards an investment project. So then whatever profit is generated from this account would be shared on a pre-agreed profit ratio. So let's say since the bank is the fund manager in this situation, most of the time the bank receives the higher rate on the profit sharing ratio. So let's say 70-30%. So you get 300 while the banks get 700. The loss is solely borne by you. This is what we mean by risk sharing. And what the bank loses here is their expertise and their time they used in investing your money. So you lose the money while the bank loses their time and expertise. It can't sound totally unfair. There's very many instances where the bank loses as well. But most of the time, this would never happen because, for example, living in Kenya, where it's a non-Muslim majority country, most of the time the central bank regulations would require some form of consumer protection, which would make the bank forward your funds towards an investment that very low risk. So most of the time this wouldn't happen. This is just the explanation of what Mudaraba is. A practical example as shown by the author in the book. For those who are interested to know how Islamic Bank fares in the financial industry, the author at that time, this book was published almost more than 10 years ago. So these examples are quite outdated. The Bank of London and Middle East at that time, an Islamic bank, reported that their customers were mostly non-Muslim. Another instance, HSBC, another Islamic bank, explained that there had been an increase in understanding of what Islamic finance is, and that non-Muslim customers like the ethical stance that the accounts take. Another common product is the mortgage, which most of us commonly know as mortgage. The Islamic mortgage version is via this product called BBA, where you as a customer approach the bank that you are interested in buying a home. The bank appoints you as an agent to find the suitable home for you. So now you approach the vendor, find a home, and the bank promises to buy this home on your behalf so that later you promise to buy it from the bank on a deferment basis. So the bank would pay the vendor on spot basis, like cash and on spot, and sell it to you at a markup, a profit. So then you'll be paying the bank in installments. So most of the time, this type of product resembles the conventional product. It's just the payments, the cash flow, all of it resemble a normal mortgage, because you would say, okay, is Islamic finance just charging interest backdoor? Because now in a normal bank, they'll just tell you this is the interest rate and this is what you pay monthly. And Islamic finance has to go a step further and tell you, I'm buying it from you, and then I'm selling it to you. So, it's kind of, it looks fishy, especially if you're new to Islamic finance and a bit skeptic about the entire system. But then Here, what makes Islamic finance different is that in Islamic finance, the legal relationships are set up and enforced. Most contracts are constructed with several separate legal relationships, which must be fulfilled consecutively, not at the same time, in order that riba is avoided. So, without the bank taking a step to buy the home for you first and then sell it to you at a markup, there are all these kinds of contracts that you must sign and which are legally enforceable, meaning that when there's a breach of such a contract, then you're liable to face the law. So, like the first agreement where the bank promises to buy the home on your behalf, and then you promise to buy it back. That's a separate legal contract. Then now you a separate contract where you have now the home is in the bank's possession and is returned to you. That's another contract. So all these contracts must take place in steps, yani in one by one. So now, what constitutes this markup? What makes it legal and valid for the bank? Because the bank took ownership and therefore faces the risk that the assets could be destroyed even before handing it to you. So the value of the home might go down, or maybe um, you you might change your mind. By that time, the value of the home has gone down, and now the bank has to find another buyer for it. Things like this. So that risk that the bank takes should be rewarded. Another thing is just like the first point, when I mentioned that contracts must be legally enforceable. So any breach is liable to facing the law. Another major difference here is that in an Islamic financial product, profit rates and payment terms must be fixed. So conventional loans are usually floating rate products. The cost of borrowing is adjusted up and down as interest rates change. Islamic finance, on the other hand, is like once you sign the contract, everything is properly set up. No, the payments, the amount of payment, the number of payments, and the payment amounts don't change, whatever happens. I would also like to cover conventional insurance and why Islamic finance objects to conventional insurance, because there were some concerns about health insurance. Now, one of them, the two major reasons are because insurance contains these gambling and maisir, which are the major prohibitions in Islamic finance, like we discussed earlier. In terms of gambling, conventional insurers are organized mostly as shareholder companies. Their purpose is to make a profit for their shareholders at the expense of policyholders, now the consumers, the ones who are insured. On the other hand, the insurer would probably underestimate the premiums and make a loss. For the policyholders in this case, now the ones who are insured will benefit from paying less. So it's either I pay a premium, and in a month I have a payout that is way larger than my premium, or I I have paid premiums for so many months and I have never claimed anything. So this is unfair on both parties, both the insurer and the insured. In terms of riba, riba is any additional money that you earn that is not of premium. riba occur in insurance? First, when an insurance policy promises a predetermined amount that is greater than that placed in premiums. So let's say they already have determined the premium is this amount, and you can only claim this much, which is usually much more than the premium, then that's in itself is riba, which can be avoided if the contract provides for a share of profits rather than fixed interest. Like we will see how an insurance policy works in Islamic finance. Secondly, when premiums are invested in business, such as conventional interest-based bonds, riba occurs from the fixed interest received. So another is like the money that they get from premiums is invested in riba generating activities. So that's another main point. To give an example of how an Islamic insurance would work, there is takaful. One of the structures that is mainly used is our color, which means agency. So in this type of operation, we have the takaful operator and the policy holders. First, first and foremost, usually the takaful operator um, would separate the funds received as premiums into two, in donations and other ones as investment in an investment funds. So there's a donations section that will be responsible for paying out whenever there's a claim. Then there's an investment section. So the investment profits and losses, these are occurs as surplus, which is redistributed back to the policyholders, that is consumers. So this is um, what makes the kaful different, the profit sharing, risk sharing nature. So the key takeaways, as I'm running out of time, the author is reiterating here that Islamic finance is for everyone. Islamic finance is linked to real assets, so real economic activity, rather than making money on money, which is prohibited. The essence of risk sharing versus risk transfer. So either party, the bank, consumer, they share risks and they share returns. And Islamic finance, as it seems to many people, not Islamic finance can make profit within ethical constraints. Case studies show even that Islamic banks perform competitively. The case study I mentioned earlier on the UK banks, global relevance has been adopted in so many countries, and it has a financial model that is suitable for a more sustainable global economy. Thank you. In the interest of time, I haven't been able to cover as much as I would like, but I hope I have encouraged you to be more curious and read this book, inshallah. Any questions? Alaikum salam. I don't know if someone is trying to speak to me, but I have about 5 minutes left. Or do you have any experience with Islamic finance, or what do you feel about it? Anyone? Sorry, I got lost there for a second. Anyway, thank you for joining me on my first ever book review. and hope I'll see you in future, inshallah. I want to encourage you, like the author has, to just go for it. Open an account with Islamic Finance. That's the only way. The book can only provide you with so much information, but you have to do the practical aspect of it. That's the only way you learn, inshallah. Thank you. Bye bye.